Hello and welcome everyone. Um, my name is Charlie Durant. I'm going to be moderating this session for us. And I'm pleased to say we've got an array of excellent guests to talk us through this really interesting part of the value chain. So joining me today, we've got Angelina from Fitch Ratings. There's Daniel from Commerzbank and there's Lucy from RMI. So please keep your questions coming in. We've got a good number already. So I'm going to go move straight into our questions. And I think the best place to start, this is going to be a question I think probably best place for you, Lucy, actually is, how does an assessment and disclosure framework help the steel sector decarbonize?
Yeah, first of all, thanks so much, Charlie, for featuring this panel and for inviting me to speak. So great question. Really, the idea of this methodology is to create a common standard. And this has been developed by the members of a working group, including some of the largest lenders to the steel sector. So it includes ING, SocGen, Citi, UniCredit, and Standard Chartered. Together, they've developed the sector-specific methodology, which really provides lenders with a framework they need to first and foremost understand the climate alignment of their steelmakers, of their clients. So where their clients are on this pathway to zero. And second, then to engage clients in conversation to encourage the adoption of net zero and interim emissions reduction goals, to understand their transition plans, et cetera. And then third, and this is where we get into the actual decarbonization, where appropriate, they can use this to engage with clients to discuss specific opportunities for emissions reductions, whether that's improving steel production efficiency, or transitioning to net zero compatible technologies. And as part of that, really to work with our clients to explore the financings available. So I guess just in short, through enabling steel companies to tell lenders where they are in their decarbonization journey, and I guess more importantly, like the distance that remains to that net zero scenario, banks can annually monitor progress and really provide the tools necessary to engage more meaningfully with their clients.
That's really interesting. And I think we've got a few questions which could tack on nicely onto that. So I think this one's probably, well, it's directed towards you, Angelina. So the question is, as steel producers are assessing various decarbonisation strategies, will the selection of different methods affect the ratings differently?
It really depends on the strategy. So we will assess the strategy on a company per company basis, how the strategy fits the company's asset base, how it fits the geographic location, and more importantly, how it adheres to the regulatory framework in this particular geography. We will also consider whether this strategy will provide the sustainable platform and the background for the companies to tackle energy transition in the longer term. Because some of the decarbonization strategies are really focusing on the optimization, cost optimization, and they may not place the companies well for the longer term requirements of the decarbonization and of the energy transition. So we will take into account all the elements of the strategy. And as you know, the ratings are forward-looking. They're based on the forecasts. And as part of our forecasting process, we consider the defined and known elements of the strategy, meaning CapEx, meaning potential impact on the operational profile of the company, etc. And this will help us determine whether the ratings might be affected or not. But as of now, we haven't taken any directional rating actions in the steel portfolio because of the decarbonization strategy. Because based on what we've seen so far, and obviously it's related to the portfolio that we currently rate, based on what we've seen so far, the companies are well placed to tackle the CapEx programs and their plans for decarbonization.
Okay, that's really interesting. I think there's a question here again on financing, and Daniel, I think you're probably best placed to look at this one. We are getting pushback from our bank regarding the financing of our breakthrough technology business. So what type of capital should we be looking for? How would you advise the asker of that question?
First of all, thank you for this excellent question. I think, generally speaking, there's not necessarily one size fits all, and we always need to carefully review as to where exactly the technology stands in terms of its technology readiness and how such a technology can be de-risked from like a number of factors in terms of where does demand stand, where does supply stand, and so on. So ultimately, the earlier on it is, like if you're basically more looking into R&D type of stages over here, then the more on the public funding side we probably will be from, let's say, grant, public funding, and so on. Perhaps even development banks and so on. Once you basically move over to the more pilot projects and early development stages, this becomes like a little bit more financeable. Like we clearly start looking into more risk-prone capital over here, particularly VC capital and so on. And the more mature the technology is, the more set up the entire like product and concept per se is, the more it is proven, the more bankable it actually starts to become. Like ultimately, it sort of translates like in the late stage of the early development phase, once a project has been proven up in a commercial environment, we can start looking into it from a banking perspective. Once it clearly is like at scale to commercially deployed, for instance, at this point in time, you can also start looking into capital markets financing. Now, there's certain deviations which do apply over here, especially once it's within the umbrella of a larger organization, which already does operate proven technologies, brownfield technologies, and so on. Over there, you can certainly look much earlier into capital market financing structures, especially with all the new green transformation tools. So ultimately, there's not necessarily a one size fits all, but every opportunity needs to be very carefully evaluated together with advisors or whoever it actually may be.
Cool, thanks, Daniel. And then I suppose our next question kind of moves from the micro of that single company to the more kind of macro. And this one, I think, over to you, Angelina, if possible. And the question is, which steel companies are better placed to tackle the decarbonisation process? So again, moving from the kind of micro one firm to the more kind of industry-wide question, what's your thoughts there, Angelina?
The short answer is large and diversified companies. And that basically means large and diversified steel producers and the companies that have strong credit metrics. They're generally better placed to address the steel decarbonization challenges. First, they benefit from asset diversity. For example, most or a lot of steel producers in the US use EAF technology already. If you look at Europe, it's probably 50-50 split between BOF and EAF technology. And then in China, it's predominantly BOF. So the regional diversity and asset diversity helps. Second, the larger companies have the financial flexibility to fund large investment capex programs and to raise funding on the markets, as we just discussed. They're also better placed to involve various constituents into the funding process, be it a private partner or the state. For example, ArcelorMittal plans to fund about half of its capex program with the help of the state. And if you recall, I mentioned in my presentation, so their decarbonization plans up until 2030 include $10 billion of capex, of which $3.5 billion is up until 2025. But then half of this capex is expected to be government funded. So overall, it's just large diversified companies which have the levers to manage the transition process in a much more efficient manner.
Okay, I think we can think about some of that in future questions as well. And Lucy, there's another question here, I think, again, on the very broad and the very kind of, I suppose, macro for the steel sector, which is, how has the Steel Climate Aligned Finance Working Group gone about creating a framework that is both realistic for, let's face it, a highly complex and a highly emitting sector, but it's also meeting the ambitious climate needs that I think the world has at the moment. So how did it go about balancing those two concerns?
Yeah, great question. I guess in short, we have, I believe, been able to achieve this through a lot of stakeholder engagement. So the Center for Climate Aligned Finance at RMI, that's the facilitator of this working group, we hosted and facilitated about 5 consultations to consult with stakeholders across each of the components of this framework that I shared in my presentation. So we had a consultation on the methodology, roadmap, financial scope, and one on the company reporting guidance, just to make sure that this reporting guidance is feasible for steelmakers to report against. We tested this with like over 25 banks, something like 40 companies, and about 10 expert organizations to vet the framework and really test a lot of the assumptions and make sure that it achieves exactly what you've just asked, is something that's both feasible and realistic, but also that is ambitious enough to meet the really significant challenges faced by this otherwise considered hard to abate sector. We also, just to note, adopted several of the recommendations of an industry organization, the Net Zero Steel Pathways Methodology Project, to make sure that this standard is material specific. And we really wanted to optimize for an incentive structure that can achieve emissions reductions, which we did so through differentiating between emissions from primary steel separate from the emissions from secondary steel. So yeah, a lot of stakeholder engagement. And I think just one other point to make here is we, as part of this, and I presented on this, we decided to adopt an alignment zone or corridor of scenarios rather than just one net zero or 1.5 C aligned scenario to try to do exactly what you've asked. So one is to have something that's ambitious enough that can serve as that benchmark for target setting purposes. And that's done through the IEA net zero emission scenario. And then also to really try to achieve real economy impact, which is the ultimate objective here. And that is purportedly or hopefully achieved through the application of both of these scenarios. So when used in tandem, the working group felt that this tool could really provide banks with the information they need for client engagement and advocacy purposes. And so we've kind of, I think through selecting two scenarios, have been able to thread the needle of striking something that's both ambitious, but also feasible and realistic.
Yeah, I think when you look at the scale of the challenge in front of the steel sector, I think it's so interesting, the work that you've been doing here to try and map out a sector that is responsible for close to 1 in 10 of all the tons that we put out. So yeah, vital work. Daniel, question here. Is it fair to assume that as long as there is no business case for investing in low carbon steelmaking tech and without public money, so support, conservative private capitals can't do much? Does that make sense, that question?
I believe so. I mean, generally speaking, it always depends on the risk appetite of an investor. And clearly, banks are not into the business of providing high risk money. There's very stringent capital regulations on banks. So it's quite difficult for banks to chip in. Even like for certain capital market products, and you basically may be able to chip in over here as well, Angelina, like from a ratings perspective and so on, there is very severe constraints as to how such capital can be provided. So, I mean, again, I think it sort of depends on where exactly you're trying to come in and what exactly you're trying to finance, how the exact technology is being de-risked, both from a merchant, a technology, but also a construction perspective to a certain extent. But then, and that's perhaps the positive thing, like, if I'm thinking about breakthrough technologies, I'm particularly thinking about the entire plasma smelting and everything, which is supposed to come like in the years ahead. Now, for certain other projects, we actually see quite some movement at the moment. The banks have given out quite some strong commitments as to wanting to participate in the financing of the green energy or the green transformation in general. And while banks cannot necessarily shift their amendments like too rapidly over here, there is certain technologies like the DRI-EF technology, which is increasingly becoming bankable as certain startups, particularly in Europe, more like demonstrate if you look into the Nordics. But then also like it sort of starts depending like a little bit on like what exactly you start including over here, because once like the hydrogen electrolyzer front again is being less proven versus the DRI-EF front, but you can decouple these things. And I think ultimately there is different ways of how banks can support. There's different ways of how risk capital does have its very important role to play over here. And there's a good mutual basis for it all to come together.
Angelina, anything to throw in there from a ratings point of view?
From the rating agency perspective, we look at it from a slightly different angle. So when we analyze the company, history is history, but the future is much more important. So we build our forecast for the next 3 to 5 years. And the forecast takes into account the defined elements of the strategy, of the investment program, financial policy of the company, how the company, preliminary plans of how the company plans to fund the investment program, etc. And this is what is incorporated in the ratings. Obviously, we do acknowledge that there may be a risk in the future, which is related to the development of the unknown strategy or just generally implementation, execution of the steel decarbonization. But overall, the financial forecast is based on the known elements of this strategy, the financial elements of this strategy, and operational if there is a switch from one technology to the other. And obviously, we do take into account the capital structure. So if it is fully debt funded, whether it's capital markets or bank debt, it's kind of a secondary consideration for us, but whether it's debt funded or whether it's equity funded by the shareholders or whether there is any state involvement. So these are kind of key considerations for us. Because as I mentioned in my previous example, some market participants for steel producing companies are expecting the state to step in and provide some sort of support. That's again, this is something we will consider. But perhaps there is the other angle to this question. So one is whether the financial community is willing to fund unknown strategies and take the risks. But then the other angle is there is the investor community, which is putting more and more pressure on the companies and not only on steel producers, but kind of across the commodity spectrum. It's putting more pressure on the companies to become more aware of the energy transition and become more serious about it in terms of their future strategies and positioning. So that's also the angle we're looking at.
Cool. That's a really comprehensive answer to that question. We've got another one that's come in here. Again, it's probably stepping back from that question on a more broad sense. Over to you, Lucy, I think, on this one, which is, why are lenders interested in the decarbonisation of the steel sector? So I think that kind of gets to the root of why we're all here today. Why is it that you see the lenders having an interest here?
Yeah, we get this question quite a bit, actually, where people are surprised, I suppose, that this is a voluntary initiative in which there's 5 banks that are on the working group, and then something like 20 plus banks have participated in reviewing the methodology. I think there's several reasons that I also would be interested to hear from Daniel, my colleague on the line here, to understand his perspective coming from a bank. But I think what we are seeing is threefold, I suppose. So one would be risk management. As everyone here knows, just given the sheer carbon footprint of the steel sector, it could present certain transition risks from abrupt policy shifts that would be required to limit warming, which could result in stranded assets, of course. And I think actually in terms of stranded assets, what I've read is that in the steel sector, there's something like an estimated 70 billion of investment that's at risk of stranding. So that's significant. And then second, we're seeing growing stakeholder pressure, especially coming out of COP26. I think there was significant increase or raising of ambition for financial institutions. People have probably seen just, the numbers of banks that have come together to join the UN's Net Zero Banking Alliance. I think there's over 100 by now. And those banks, as part of that Net Zero Banking Alliance, have committed to decarbonize their lending and investment activities. At the Center for Climate Aligned Finance, we see this a lot, where there's financial institutions that are committing to decarbonize their portfolio or committing to align with net zero in terms of their lending portfolios, investment activities. It's one thing to set a target, but without an implementation plan, banks can, run the risk of failing to meet their commitments. So I think that's another big reason for a lot of the financial institutions that are participating in this framework, is just trying to grasp something that can help them actually achieve those really ambitious goals and commitments. And then third is just opportunity. There is tremendous opportunity in the net zero transition. We've heard this today on several of the panels. And so, yeah, I think probably risk, stakeholder pressure, and also opportunity. But as I mentioned, keen to hear from Daniel as well on this one.
Yeah, me too. So over to you, Daniel, please.
In all fairness, I can only second your thoughts over here, Lucy, and you're absolutely spot on. Like, on the one hand, banks themselves receive a lot of shareholder pressure as to more is like being an agent of change or a facilitator for change, which is then being enforced to the loan books, to the loan portfolios, to the companies we are working together with. The second aspect is also there's actually quite a fair chunk of regulatory pressure in here. So particularly when you more like think about the EU taxonomy, like banks like us, but also everybody else are being required to actually look into carbon reporting of companies and even make it part of our credit process. In fact, from 2024 onwards, it actually will be part of the credit process and influence loan-taking decisions to quite a tremendous effect. Vice versa, this certainly also translates into banks not only taking or seizing opportunities over here by dedicated financings to the green transformation, but also actually having to enact rules to the companies as we more like receive the pressure ourselves from regulators, but also our own investors.
Okay. I think that, Daniel, there's a follow-up question here that we can tack onto that, which is, I think, thinking about why lenders are interesting, but also which types of companies can successfully get capital market financing, especially on the green transformation or sustainability linked debt products. So moving from the kind of why, I suppose, to the how would be over that question.
Yeah. I would summarize it as follows. I think particularly larger companies, perhaps listed companies, companies with a solid and strong balance sheets, which thereby certainly fulfill the requirements by Fitch, by S&P, by Moody's, the different rating agencies. They can certainly go for rated or perhaps even non-rated capital markets financing over here. You can certainly then also start looking on the equity side. Can you more like issue like new shares and stuff like that? But I think generally speaking, a certain minimum size will be required for companies to basically make the case over here. Now, this said, a number of steelmakers are relatively consolidated, are relatively big, particularly based on the current market environment, have stronger balance sheets than they used to have in the past, amid the formidable results achieved over the course of the past 12, 18 months. So I think, yes, long story short, more established, more solid, stronger companies in this respect. Is there anything you would want to add, Angelina?
Probably not. It's a very good summary.
We've got a general question here, which I'm going to put out to all of the panelists, which is, and Angelina, if you'd like to kick us off, what do you see as the biggest block currently, or the biggest blocker currently to steel companies accessing the finance that they need for decarbonisation? So what's the biggest blocker in your view currently?
It's probably the technology, and by technology I mean not only the technology itself, because DRI-EF is in existence, but all the components around it. So meaning renewable energy, the infrastructure, hydrogen, and availability of hydrogen on the industrial scale. Let's just call the whole block of all these elements technology. And then the second one is obviously funding, because it's a long-term development. And the funding is quite substantial. If I recall correctly, the initial estimates were over $50 billion up until 2050. So that's the initial transition.
Okay, I'm going to move around the panelists as you guys appear on my screen at least. So Lucy, over to you. What do you see as the biggest blocker currently in this sector?
Yeah, I think it depends on the geographic location of the steel company. Just because in some instances, as Daniel spoke of in the EU, there might be more regulatory certainty than in other geographies. And regulation and regulatory certainty are going to be really key, especially to provide that public financing and de-risking mechanism that Daniel presented on earlier. So I think, I would just reiterate what Angelina said. A lot of it is the technology and the infrastructure, but also just regulatory certainty that there's a carbon price that's coming, or some sort of support from public financing sources.
Carbon price is a good point, and hopefully we'll have a chance to talk about that as the last question of the day. But Daniel, what do you see as the biggest block currently?
It's very much in line with what Angelina and Lucy have already pointed out. I think particularly when I talk to our clients at the moment, the availability of green energy seems to be like one of the key concerns of steelmakers, particularly in Europe. Where is green hydrogen supposed to come from? There's certain limitations in terms of how it's supposed to be transported, but also how it's supposed to be built out. And at one point in time, it's also coming down to a question, who's actually going to get access to green electricity first among all the different industries who are battling for the same over here. So clearly the energy build out is like one obstacle I see in the market at the moment. I also observe a minor, I don't really want to overemphasize it over here, but a minor standstill where certain bigger European steelmakers are currently waiting for the next round of public grants to be released. The first round has been released. SSAB has received funding in this respect already. However, some others have not yet. And for some, it appears that this is holding back the plans a little bit. Very currently, like certainly the developments in the energy markets are perhaps sending the one or the other a little bit back to the drawing board. And finally, once I more look to the US or to Asia, in the US, the market seems to be very buoyed by the fact that results have been phenomenal. Like one steel plant is being announced after the other, it almost feels. And finally, once I look into China, it more comes down to public support again. Now, one final aspect I would want to emphasize over here as well. Now, while many players would want to decarbonize over here, as it appears, there may perhaps also be a constraint on the steel plant equipment maker side, which is widely overseen at this point in time.
Well, thank you for that, and thank you to all of the panelists today. That was a really interesting run through of some of the opportunities, some of the risks, and some of the things that this sector is going to need during its decarb journey. So with that, I'd like to thank everyone who has viewed this, and thank everyone on the panel. And have a good day.
Thank you.
Thank you very much.